Hello, my name is Darryll Esch with ClearHome Mortgage Solutions. Today we are talking about why I believe the 10-year fixed-rate mortgage offers more protection, stability, and potential savings than any other available term in the market today. In 2012, we have the rare opportunity to actually take full advantage of all the benefits of a 10-year term. But before we begin, in order to even consider a 10-year term, you need to believe that interest rates are going up. If you have any doubt, take a look at this chart. It shows a comparison between 5-year fixed rates and the Bank of Canada prime rate over the past 25 years. When you review it closely, you will see that every period of low rates is followed by a significant quick increase in rates. This happens because the government uses the variable rate to help curb consumer spending and manage inflation. When interest rates are low, Canadians spend more. When interest rates are high, we tend to spend less. And what the government has found is that if they slowly increase rates, spending habits don't change. So what they do is they rise them quickly, so that new borrowing costs us dramatically more, and immediately we become reluctant to borrow new money. All at once the economy slows down, and the risk of inflation lowers. Now, with that being said, multiple economists, the Bank of Canada, and even the Prime Minister have been forthright with Canadians. They have all told us that the interest rates that are currently available today are considered emergency interest rates, which means they are only available to help stimulate the economy and they will disappear. The writing is on the wall for rates to rise. The only question is, when will it happen and how high will mortgage rates go? Now, if we listen to economists, they believe that interest rates are going to remain low for the balance of the year and should rise in early 2013, which means that we are coming to the end of the emergency rates. And even though they are not predicting huge increases in the variable and fixed rates, consumers need to prepare for them to return back to their averages. Understanding this is key because as we get closer to when interest rates begin to rise, the low long-term fixed rates will disappear quickly. And as mentioned earlier, when rates start to rise, it happens fast. And with interest rates being at all-time historical lows, now is the time to consider locking in before these rates disappear. You can currently protect your mortgage right now for about 3.99% for the next 10 years, which is lower than the average variable rate since 2000 and 2.78% lower than what the average 5-year rate is. Now, I know that I failed to show you what you can get in a 3 to 5 year rate, and I did this because I believe that these rates are financial traps that are going to lead you to renewing your mortgage in the heat of increasing rates in 4 to 5 years. If we look at today's rates, you'll have the following options available. But the mortgage that I see most people drawn to or gravitating towards is the 4-year fixed rate, and it's being offered between 2.89% and 3.19% today. I've heard most people talk about this mortgage saying that they like the shorter term, and if they want to refinance, they can do that sooner and get more money if they need it. And as well, it's lower than the 5-year fixed rate, and in most cases, even lower than the variable rate. And it is the mortgage I would recommend if we didn't have the option of a 10-year term. So for the remainder of the presentation, we're going to be comparing the 4-year fixed rate to the 10-year fixed rate, and see who comes out on top after a 10-year period. Okay, we are going to compare two mortgages. A mortgage with a 4-year term, 2.99%, a $200,000 outstanding balance, and a 10-year mortgage with the same $200,000 balance and the same payment on a monthly basis of $1,050.96. Now, after 4 years, we're going to see that the 4-year rate, the outstanding balance is $171,000, while the 10-year rate after 4 years is $179,000. Now, that's about an $8,000 difference between the 4-year and the 10-year. And this is why a lot of people are gravitating towards that 4-year rate, because that $8,000 of savings is very, very attractive. But what happens is that if we go one step further and we understand that at renewal, that 2.99% disappears, and now you've got to renew back into the market at a new interest rate. Now, statistics will tell us that that new interest rate is going to be around 5.5% in 4 years. So if you're able to get the average rate in 4 years of 5.5%, after 10 years, your mortgage balance will be $148,000. Now, the 10-year, though, has maintained that 3.99% rate for the entire period of this term. So it now has the advantage for the next 6 years. And as a result, the balance at the end of 10 years for the 10-year term is $142,000, which is now $6,000 better than what you would have gotten if you went with the 4-year rate. Now what we need to remember is that 5.5% is just an average of the 5-year fix since the year 2000. So if we look back a little bit further and we take the 5-year fixed rate average for the past 25 years, we'll see that that average rate is 6.72%. If you renew your mortgage at a rate close to that, you're going to find out that your mortgage balance after 10 years is right around $163,000. Now the 10-year rate hasn't changed. Its rate has stayed at 3.99 for the entire 10-year term, and its outstanding balance is still $142,000. But the difference is that now the 10-year fixed has saved you about $21,000 in comparison to the 6.72%. Now, we don't have a crystal ball and we can't predict what rates are going to be like, but we know that if rates are higher than 4.93% at renewal, we'll have the same balance as the 10-year fixed plan. So at renewal, if you renew for more than 4.93%, the 10-year fixed rate is going to be better. And statistics show us that the 4.93% is already a very low rate, and we haven't seen that in history very often. So we should be expecting to have a higher interest rate than 4.93 at renewal in 4 years. Now, one of the other advantages of the 10-year rate is the fact that the payment doesn't change for the entire 10-year term, where if we look at the differences between the 4-year fixed rate, as soon as that interest rate increases or changes and that term ends, you will be required to do one of two things. Either continue to pay the $1,050 or increase your mortgage payment to continue to have the same amortization. So for example, if at renewal you continue to pay the $1,050 payment on a monthly basis, if you renew into a 5.5% rate, it will take you an additional 24 years from that date to pay off your mortgage, meaning it'll take you 29 years to pay off your original 25-year mortgage. In order to correct that, you would need to increase your mortgage payment to about $1,175 to still maintain your 25-year amortization. Now, if we go to the 6.67%, if you maintain that $1,050 payment, it'll take you an additional 39 years to pay off your mortgage. Or, in order to correct that, you'd have to increase your mortgage payment to just under $1,300 a month in order to maintain that the 25-year original amortization. Now, at that time, if you were to take that opportunity and increase your payment onto the 10-year fixed rate at 3.99%, you would actually prepay an additional $8,300 of extra principal on your mortgage, further benefiting you and making the 10-year rate even stronger. To summarize the advantages of a 10-year, we just got to review everything one more time really quickly. First off, protection against rising rates. We understand that the variable rate is really low right now, but the goal of anyone who is on a variable rate is to maintain a low average rate. Now, we know over history that low average is about 4.09%. So now that we can lock in at 3.99, which is below that average, there really is no advantage to riding that wave. There's no reason to take the ups and the downs to try to maintain that 4.09% average when you can get it in a 10-year fixed automatically. And plus, the mortgage payment stability that comes along with knowing that that rate is set so low for a lot of people, is going to save them when it comes to their budget. With all the pressures that are put on our cash flow, knowing that our mortgage payment isn't going to change is a real advantage. Now you can purchase that new car, help the kids with that new sporting activity, because you're not worried about your mortgage payment changing. And because it's set up the way that it is, you also know and you're guaranteed how much money you're going to owe at the end of your term. It's a great option for that protection and certainty that a lot of Canadian families are looking for. Now, I put this point in here about a lower outstanding balance for the 10-year fixed because if it's managed properly and you take advantage of increasing your mortgage payments as rates start to increase over time, you're really going to see some major advantages and see that principal decrease very quickly. Now, managing your mortgage is very easy to do, and it's one of the specialties that we work on at ClearHome Mortgage Solutions. So not only are we going to help you put this 3.99% rate in place for you, but we're also going to show you how to manage it over time to take full advantage of rising interest rates and the protection you'll receive while using that 10-year fixed rate. Now, I know this video has been a little bit long, but I wanted to thank you very much for getting to the end of it. It is actually very important, and I want everyone to have this information. Now, even though I believe strongly that the 10-year rate is the product to go with, I'm always open to suggestions and solutions and comments from all of my clients. So please feel free to make a post below this video and tell me what you think about the 10-year fixed rate and how it would work into your family or wouldn't. So again, thanks very much for watching the video. I really appreciate your time, and if you have any questions, please contact me directly. My phone number is 204-888-4008, extension 5. And once again, thank you very much. This is Darryll Esch from ClearHome Mortgage Solutions, your mortgage optimization specialist. We'll talk to you soon.